What the heck is mortgage insurance? And how can you get the cheapest mortgage insurance possible? And in this video, I'm gonna break that down. But first, so mortgage insurance, what is it? It's in your payment, you see it, but what is the point of it? Mortgage insurance, in short, is to keep from everybody having to put down 20% on their mortgage. Because of the exposure, mortgage insurance came along, so that way if somebody was to default or get foreclosed on, this insurance is going to make up that difference from the 80% in the sales price for the mortgage holder, the one that owns the mortgage. And that's why. This is not homeowners insurance. This is mortgage insurance, so it's to protect the mortgage holder or owner. So if you can avoid it, you want to avoid it. And if you can pay the least amount possible, shoot, you want to do that too. So first off, let's talk about FHA loans. It's pretty easy to go over this topic. There's going to be a factor when it comes to mortgage insurance. For FHA loans, if you're putting down 3.5%, the factor is 0.55, which times the loan amount divided by 12 is how they come up with this number. And then if you put down 5% and less, then it's only 0.5. So on a $400,000 loan, MI with 3.5% down payment, your mortgage insurance is about $182. How long is it gonna stay on your loan? If you're putting down less than 10%, it'll stay on your FHA mortgage forever. So your game plan there is to refinance down the line to get rid of it. If you're putting down 10% on FHA loan, with the vast majority of people aren't, the mortgage insurance will go away after 11 years.
Wow, that's amazing.
Now let's talk about conventional loans. A lot of things come into play when you're getting or have mortgage insurance on a conventional loan. You've got credit score, you've got down payment, you even have debt ratio. And this is something to keep in mind when you're shopping lenders. Sometimes I'll see lenders lowball the mortgage insurance, like making it a flat number, like it's $40. It's never $40 because it's a calculation. So it's gonna be $43.74. So if you see a flat number, I can tell you right away, it's probably wrong. They're lowballing it. It's also based on your debt ratio. So if you're shopping without applying, they don't even know what the right mortgage insurance is. They're gonna lowball it.
What?
Or they're gonna lowball it, and then as your loan progresses, magically your MI went up because your debt ratio went up.
Would you like to see a magic trick?
So some things to keep in mind when you're shopping, that mortgage insurance you need to really take out of the equation because it's gonna be the same for all lenders in theory. Let's break down some examples on how this can affect it. We're gonna use a $400,000 loan amount, 780 credit score unless I say otherwise, and a 5% down payment. And this is roughly what you're looking at for mortgage insurance based on your credit score. Most of the time, it's gonna go based on every 20-point increment. So at 800, it's about $77 a month. 780, it's about $80 a month. 760, it'd be about $90 a month. 740, it's gonna be $120 a month. 720 is gonna be $156 a month. And then it goes down. And then when you get to the really low credit scores, like 640, even though you would want to be going maybe FHA in that example, then it can be significantly high. It can be over $400. It's also going to affect or going to change based on your debt ratio. So any debt ratio of 30% and under is going to be the lowest. So you have a low debt ratio, that's going to help you save.
Something to think about.
If you're trying to get your payment down, or there's some small debts you could pay down while getting your mortgage to get you a lower MI. That's something to ask your lender as you're working with. And then a 35% debt to income ratio, so your debts divided by your income, is $83 a month. And then at 40, it goes to $90. 45%, it goes to about $93. At 48, so a very high debt to income ratio, because on conventional loans, the max is 50%. So you're very top exposure. At that point, they look at it as being a little bit riskier. Your mortgage insurance is about $140. It also changes based on your down payment. At 20% or more, you have no mortgage insurance. If you put down 15%, which you would probably want to try to avoid, you're going to have about $33 a month in insurance, in mortgage insurance. Not that much. At 10%, about $53. At 5%, about $80. And at 3%, $123 a month in mortgage insurance. Right away, what are some things to walk away from here? If you can put down 5% versus 3%, I would do that. A, you're going to get a much better interest rate. 2, you're going to get much lower mortgage insurance. So sometimes getting the minimum down payment is not always in the best interest in your situation if you can. And if you can put down 20%, great. Sometimes you can do a first and a second mortgage to avoid mortgage insurance. And a second mortgage may have a higher than market interest rate. You can also pay to have your mortgage insurance removed. It's a very large upfront fee for that, depending on your down payment and scenario. You can ask about that. The truth of the matter is this: mortgage insurance is a short-term problem because as your home increases and your mortgage insurance balance decreases, when you get to about 78% loan to value, so you owe a certain amount, 78% of your home's value, is when the mortgage insurance can go away. Now, it can be difficult sometimes to get the mortgage insurance or the mortgage company to remove the insurance in under 2 years. But in theory, as you watch it, you can get it removed. You can request it through the mortgage company. Hey, I want to remove my mortgage insurance. I shouldn't have to pay it. And they may agree, yes, it's worth it, your home value, etc. Or you may have to pay for an appraisal to back that up, to say, hey, my home is worth this, I only owe this, I want it removed. So when you're going into it, it's not ideal. You don't want it in the payment, but everybody needs it. Otherwise, we'd all have to put 20% down. And understand it's a short-term thing. How can you get your payment down? So start to look at your payments as a long-term thing instead of a short-term thing. So that right there is everything you know about how to get lower mortgage insurance, how mortgage insurance works and why, and how to get it removed. Hope you found that information helpful. If you did, I'd love to be your lender, and stick around for this next video. Think you're gonna like it. Thanks, guys.